Welcome back to the What's More podcast. I'm your host, Quentin Harris. You're dialed in for the most recent episode here at What's Your One More. Man, I'm excited to have one of our returning guests, as always, bringing great energy and knowledge. And you're in for a treat today. We just had a Federal Reserve meeting yesterday. And there's a lot to talk about, a lot to break down. And we brought one of the best to the show to do that. And not only that, we're going to get some bold predictions here at the end of the show going into 2026. And I want to remind you, last year, they ended up dead on the money with some of their predictions. We'll kind of recap that a little bit today. I'm not going to play the I told you so game, but you know, when you're good, you're good. And so we're going to talk about that today. Mr. Dan Habib, welcome back to the show, my friend.
Quentin, thanks so much for having me, brother. It is always an honor to be on the What's Your One More podcast here with you, brother.
Welcome back. So we just got done with the Fed meeting. And inside that meeting, we kind of had a different tone from this committee. It seemed a lot more dovish than normal. And even Mr. Powell himself kind of brought the doves out in this one and really headed off a lot of things. And we finally saw what you guys have been talking about for a long time, which is, hey, listen, these numbers in employment don't look great. And we're going to break that down. I'm sure you got some charts and things to show us. But lots of negative revisions kind of finally added up and came to the podium. And it was like, oh, here we go. Everybody look out. These aren't as good as we thought. And then we saw other committee members step up and kind of say, listen, we agree. And then we have the few like Bostic and some other ones that still are going to stay their course, but they're on the way out. And I'm sure you'll talk about that as well. But the good news is we did get a rate cut. I'd love for you to kind of break down to the audience why that didn't necessarily reflect in immediate mortgage relief. It's on the way, but why it's not there today. We tend to see a lot of fallacies in the environment where people go, hey, Fed cut rates, we should get lower mortgage interest rates. And it doesn't always happen like that. So I always love getting your insider knowledge on that and talking a little bit about this Fed as we head into the 2026 year.
Yeah, so listen, there's a lot to unpack. As you said yesterday, the Fed, as expected, cut 25 basis points. And you might remember at the October 29th meeting, they were expected to cut 29 basis points. They did, but then Powell, he really made it a hawkish cut. And the bond market hated it after he cut rates. And the reason being is going into the October 29th meeting, the expectation was that the next Fed meeting, which was yesterday's, was that they were going to 100% cut. But instead of going ahead and alluding to that at the October 29th meeting, Powell cut and he said, well, a rate cut December 10th, that's not a foregone conclusion, far from it. And the market took that as really hawkish. Now, listen, they ended up eventually cutting December 10th or yesterday because of the weakness in the labor market. But at the time of that October 29th meeting, that was a really hawkish statement that he made. Going into yesterday's Fed decision, the market wasn't expecting him to say, oh, we're going to cut rates in January. The market was pretty much prepped for a hawkish cut, for Powell to cut rates, but then to set the bar higher for any future cuts. And that's pretty much exactly what he did. But then his statements that he made, I think he was much more dovish than the market was expected. In fact, he went out of his way to talk about, as you correctly said, the weakness in the labor market and to downplay inflation. So, you know what, let me go ahead and just share with you this slide here to go through some of the points here together to help you kind of see this. So,
yeah, I love this stuff.
On the labor market, Powell said that not only is it not solid anymore or stable, he said that it is certainly showing signs of weakness. Now, he went as far as to say that from April to September, which is the latest jobs report we got because of the shutdown, we won't actually get the October and November jobs reports until next week on the 16th. So they went into this somewhat blind along with the CPI inflation report. But he said from April to September, we've seen on average 40,000 job creations. But then he said that he believes, as we've been saying all along, the BLS has this systemic error where they're overcounting jobs, overstating job growth, and he thinks that's 60,000 of an overstatement per month. So he went on to say that I think we're really seeing, give or take 10,000 jobs plus or minus, about 20,000 job losses each month. And something a lot of Fed members have been making the argument of is, well, labor demand and job creations have been low, but at the same time, because of immigration changes, we're seeing less labor supply. So you don't need as many jobs to be created to keep the unemployment rate stable. You know, that's all well and good, but I've never seen negative numbers keep the unemployment rate stable. And he went to go ahead and really underscore that point. So it was actually quite, validating for us to see him say that. And also on inflation, because a lot of people get confused with prices being high and the current rate of inflation being out of control. Of course, inflation is cumulative. That is a real thing. What that means is that the price increases of 25% from the last few years, those are all still there. But what we're really focusing on here is how much are prices going up right now on top of that. That's the scary thing about inflation. Once you get it, you don't really ever erase it unless you see some kind of catastrophe, terrible recession where temporarily prices can go down a little bit. And of course, certain sectors, energy prices are coming down. Sometimes you can see food be volatile, but in aggregate, prices always usually just go up. And right now, the current rate of inflation is 2.8%. That's above the Fed's target, but by no means is it out of control, especially when you really look at some of the overstatements that are happening. And Powell said just that. He said that when you strip out the impact of the tariffs, inflation's actually closer to their 2% target, not far from it. He said services inflation's coming down, but that's being offset by goods inflation going up. But he said it's only in the sectors where the tariffs have an impact. And he said he thinks that the tariff impact is going to peak in Q1 of 2026. And then you're going to start to see that being more of a downward force. So as long as there's no new tariffs that are announced, of course. So he was really, really dovish on both the labor market as well as inflation. And then, of course, the surprise wild card out there was that starting tomorrow, which is the 12th, the Fed's going to be buying $40 billion a month in treasury bills. And if needed, some potential maturities of 3 years or less as well. A bill is 1 year or less, so they might be buying some 2-year or 3-year treasuries as well. But, that was a surprise, especially the amount. There was some talks that they might do some buying to help with some liquidity issues and to make things function smoothly. But, $40 billion was more than anybody had talked about. Now, are they going to do that into eternity? They said in their statement that they're going to be buying it for the next few months at $40 billion and then potentially turn that down. But it depends what's happening in the economy, right? So this is a type or form of QE. It's not the same kind of QE for those of us in mortgage and real estate where they're buying, $95 billion a month in mortgage-backed securities and treasuries. They're not buying long-dated maturity bonds or treasuries, but they're buying bills. But it's still stimulative. It still does create some liquidity. I think it's probably a good thing for risk-on assets as well, like cryptocurrencies in the stock market. And, as we're talking here, I think I saw on the screen there that it was the S&P and the Dow hit new all-time closing highs today as a result of this. But, this is something that can really help us if Treasury Secretary Scott Bessent terms our debt shorter. One of the big headwinds for mortgage rates is that we have this unbelievable debt load. I think it's around 37 trillion now. We continue to deficit spend, so it keeps getting bigger. And, we don't have like a printing press literally like people think, but we come up with this money by issuing debt in the form of treasuries that has to get absorbed by the bond market. Well, if you're issuing a lot of 10-year treasury notes, 20-year bonds, 30-year bonds, that'll hurt mortgage rates more directly. But if you're issuing more debt on the short end, that won't have as much of an impact. So this can really help us indirectly where, hey, if they do term the debt shorter, you certainly have a big source of demand there now from the Fed, along with things like bank deregulation and stable coins as well. So this was another kind of dovish part of this Fed meeting. Now, one thing Powell did do is he did raise the bar for future cuts. And he said that he thinks the neutral rate, which, listen, the Fed could be one of three things. They can be restrictive, where their Fed funds rate is at a level that it's kind of clamping down on economic activity. They could be neutral, where they're not helping or hurting the economy. Or they could be accommodative, where their Fed funds rate is low enough where it's actually stimulating the economy. Now, when you're at an accommodative standpoint, you have to worry about, are we potentially stoking the flames of inflation? So a lot of Fed members have kind of differing views on where neutral is. Some that you see that want more rate cuts and a lot more, like Stephen Moran. Well, he thinks the neutral level is much lower, which is why he wants to see next year, like 6 cuts. But that's not where I'd say the bulk of Fed members are, right? But did Powell say that he thinks that we're now in the outer bounds of neutral, meaning, we're getting within that territory, which leads you to believe that he doesn't think there's much more room to cut unless one of two things happens. If inflation comes down, well, then you have more room to cut because you're less restrictive. Or if the labor market takes another move to the downside where they have no choice, where they have to step in. Otherwise, if the labor market unfolds, it's a really bad scenario. So he did set the bar a little bit higher. And, this Fed is the most divided that I can remember seeing since I've been analyzing this stuff, which is, I don't know, around 18 years or so. And Austin Goolsbee, the Chicago Fed president, boy, it wasn't too long ago. He was like the most dovish Fed member. I remember, I think it was earlier in the year, he said that he thought the Fed had room to cut 7 times. Well, the Fed now cut 3 times, and he was against this third cut, so much so that he dissented. And Schmidt is kind of like the Grinch who stole Christmas. He dissented at the October 29th meeting as well as this meeting. And then, of course, you had Stephen Moran. He dissented, but not because he didn't want to cut, but because he wanted a 50 basis point cut, not a 25. And he did the same thing at the October 29th meeting as well. So this is the dots plot chart. And before we get into this, I just want to mention, and we're going to go over what the changing kind of landscape is going to be at the Fed, because I think it'll be interesting and important. The Fed doesn't have all the data going into this meeting, and the composition of the Fed is going to change drastically next year, especially in May when Powell's term is up, and you're going to get a new Fed chair who we know is going to be more in line with what President Trump wants to see, which means that he's going to be more inclined to cut rates. So you have to kind of take some of this stuff with a grain of salt, because with the makeup changing that much, they're only going to be there, the current Fed chair, for the next 3 Fed meetings. And then it's going to change completely. So here's what the dots showed. And I thought this was interesting for the current year. So you have the 19 Fed members. They anonymously plot where they think the Fed funds rate is going to be this year, 2025, 2026, and you can see in the longer runs. But for 2025, so this one here, this is the current Fed funds rate, by the way, that after they just cut, it's now between 3.5% and 3.75%. The effective Fed funds rate splits the difference at 3 5/8, or 3.625. So you could see, here's all the Fed members. Some of them are voting, some of them are not, because remember, there's 12 voting Fed members, there's 19 in total. All of them get a dot, but this is voting for the rate cut that happened. This is Stephen Moran, who wanted a 50 basis point cut, but look at this. We know that there was 2 Fed members that dissented outright, but then you have 4 dots here. Sometimes what the Fed members do is they more quietly dissent, which means that if this is a voting member up here, which a few of these definitely are, they ended up falling in line with the Fed chair when it came to vote, but they're showing their dismay for the cut by putting the dot above where it is. Because listen, this is 2025. There's no possible way that you could get here after the rate cut, okay? And then here's 2026. So this is where we are currently. Now, interestingly, of the current Fed makeup, 3 Fed members want to see a 25 basis point hike. 4 want to see 1 cut. Another 4 want to see 2 25 basis point cuts. 2 want to see 3. 1 wants to see 1% in cuts. And then Stephen Moran down here wants to see 6 25 basis point rate cuts. So you can see this is a very, very divided Fed, very, very spread out. So you have 12 voting Fed members, right? And you have all the Fed governors and the chair who vote. You always have the New York Fed president who votes. And then you have these 4 rotating regional Fed presidents that vote. So the ones that are voting now is you have Goolsbee, Schmid, Collins, and Moussalem, right? St. Louis, Chicago. So Goolsbee, we know he was one of the outright dissenters. So extremely hawkish. All of a sudden, now he's out, and we're going to replace him with Hammack. And by the way, Hammack, somebody that is definitely leaning hawkish, but not as hawkish as Goolsbee. You have Schmid, who we know that's the Grinch that dissented at the last 2 meetings, going to be replaced. And the people replacing the people going out definitely have more of a dovish tone if we look in aggregate here, right? So These 4 people replacing these 4, the Fed definitely gets more dovish. But I want you to just take a look at the full breakdown of who we're going to have next year. So the Fed chair, we don't know exactly who it's going to be. Trump's playing a little bit of games. It sounded like it was Hassett. Now he's saying he's undecided. He's meeting with Warsh and Waller again. It's going to be one of those 3. Everybody thinks it's Hassett, but sometimes Trump likes to keep people on their toes, and now he's saying he's undecided. But nonetheless, any of those candidates, the one he's going to choose, all 3 of them are in line with the thinking that we are going to have more room to cut. They think our star, the level of neutral, is much lower. And I'll show you what I mean by that in just a minute. So whatever Fed president goes in there, they are going to want to cut rates more, much more than Jerome Powell. Now, listen, of course, some of these people like Hassett were asked, well, are you going to succumb to presidential pressure on cutting? What is the guy going to say? Yeah, of course he's going to say no, right? But he did say, even after the cut on yesterday at yesterday's meeting, I still think there's a lot of room to cut. Now, we do have to be careful because too much of a good thing is a bad thing, and we'll go over that as well. And then you have the New York Fed president, influential, because that's where they do all their operations, right, and their purchasing operations. John Williams, the New York Fed president, always votes. And then you have Bowman, who is dovish. You have Waller, who's one of the candidates for the next Fed chair, who's dovish. You have Mirren, who is the super dove. And then you have the vice chair, Barr, who is kind of like a centrist / unknown. And centrist means, they're kind of in between a hawk or a dove. And then you have Jefferson, Kashkari, Paulson, all kind of in that centrist to unknown. And then you have Cook, Hammock, and Logan, who are hawkish. But you can see here, from the voting members, you're definitely going to have a more dovish Fed. And of course, the Fed chair holds a lot of sway. You look at all the meetings that we see, it's unusual to see one or two dissenters even, right? Because the Fed chair usually is able to convince them to kind of following along and voting with him or her, right? So this is something that it's certainly lining up to be a more dovish Fed, and we're going to see more rate cuts next year, even though if you look at the dots plot chart for what the median is here, it's for one more cut in 2026. Do I think that's accurate? Absolutely not. I think we're going to see probably at least 3 rate cuts in 2026. But of course, the caveat, it depends what happens with the labor market, and it depends what happens with inflation. If all of a sudden you saw inflation really starting to pick up steam, I don't care who the Fed president is, you can't cut into that. But if you saw the labor market deteriorating, you might see more cuts than that, right? But nobody would be foolish enough to cut into a really accelerating inflationary market. You just can't do that. Now, some other things within their summary of economic projections from the Fed. This is something they release every other meeting. Again, you have to kind of take this with a little bit of a grain of salt because the Fed composition is going to be very different next year. But with the existing members, they think inflation's coming down to 2.5% next year. And they think the unemployment rate is going to go to 4.5% by the end of this year. And then next year, they think it's around 4.4%, and they think GDP is going to pick up next year to 2.3%. So, I'll just pause there for a second, Quentin, before we go a little bit further.
Today's episode is brought to you by Texana Bank Mortgage. They're coming to the table with a revolutionary product. It's called REMLO, Real Estate Mortgage Loan Officer. And what they are doing is they are taking real estate agents and they're taking loan officers, and for the first time in history, they're putting them together under one umbrella. They're actually taking 2 industries right now that sit on top of each other, and they're putting them together and backing it by a full-service bank licensed in all 50 states. So imagine this, you're not just an agent anymore, you're a full-service agent. You're the single trusted point of contact for your client in this entire process. You're seeing the loan and the home search front to end. It's going to change the dynamic of real estate and mortgage lending together. Now, if you're a real estate agent, I want you to do me a favor. I want you to go to askaboutremlo.com. That's askaboutremlo.com. Because what you're going to find there are significant details about this program, how to enroll, and how to gather more information. So if you're ready to adapt and thrive, go to askaboutremlo.com. That's askaboutremlo.com. So we're looking at the dot plot map and we talk about a new dovish Fed composition. Let's break that down for our audience. Layman's term, what does that mean for the buyer? Potential sellers, mortgage lenders, real estate agents? Are we thinking lower rates? And if so, what are we thinking that looks like? Or is it going to be a delayed reaction to what's happening right now?
So let's talk about this, right? So first off, what's a dove? What's a hawk? What's a centrist, right? So a dove is somebody that would be more for accommodative economic policy, which means that they would be more in favor of cutting rates or potentially more in favor of something like QE, although I don't think many Fed members really are looking towards that or in line with like a big QE effort, unless it was like, a COVID or a really bad recession type scenario. A hawk is somebody that wants tighter monetary policy. They're more concerned with inflation right now, less attention to the labor market. They're less likely to hike rates. And then a centrist is someone that's kind of in the middle. So let's talk about how the Fed can really influence mortgage rates, right? Because they are not cutting the 10-year treasury. They're not cutting 30-year fixed mortgage rates. They are cutting the Fed funds rate. Now, that is not a long-term rate. It is a very short-term rate. It's actually an overnight rate that banks use to lend to one another. but it does have a direct impact on short-term rates. So when the Fed cuts, SOFR goes down, your money market accounts go down, your short-term treasuries, your credit card rates, your car loan rates, things like that. But long-term rates are more indirectly impacted. Now, a lot of stuff I see out there, people look to 2024 and they're like, well, the Fed cut and rates went up. And, listen, you can't just look at things myopically. You can't look at what happened immediately after the Fed cut rates and say that's the full reaction. Because when you learn the Fed's going to cut, markets are forward-looking and they move in advance almost always. So you have to look to see how the Fed rate cut is impacting things by looking at, I think, three things that are most important, right? Number one is, how does the market react in advance of the cut once they learn about it? Then, is there any coincidental economic reports that are released after the rate cut that are causing rates to go higher, not necessarily the Fed cutting rates itself? And thirdly, and potentially one of the most important parts is the rate cut being deemed as inflationary or thought of as inflationary? Because I said before, too much of a good thing can be a bad thing. Listen, I think there's still some room to cut rates. Personally, I think you could definitely cut 2 or 3 more times next year and not get to a level of neutral where you're not get to accommodative levels where you're stoking flames of inflation or anything like that. But
Agreed.
If you were to cut to like where President Trump says you want to see, that would be problematic. You can't cut the Fed funds rate down to 1%. Okay, that would be crazy, and it would have actually the opposite impact of what they're trying to accomplish, because they say so much how they want affordability in housing, they want to see rates come down. There's certainly not a direct correlation there. There's an indirect one, and I'll show you that correlation in a second. But if you were to cut that much, the bond market would tighten for them, and you would see long-term rates move higher because it would be thought as inflationary. So let me show you a little bit about what I'm talking about here, and I think it will make some more sense. So first things first, you hear me talking about restrictive and different levels of what that their policy can be at. So I think this is somewhat helpful, right? You might be wondering, why do some Fed members think there's so much more room to cut than others, right? So here's a calculation on how you figure out how restrictive the Fed is. And this was actually before the Fed's cut yesterday, right? So the Fed funds rate was at 3 7/8. The level of inflation currently is 2.8%. There's something called R star that gives you an idea of how restrictive things are in the economy. That's a variable one where, the super doves out there think this is lower. This is kind of like a median here where most Fed members think it is. You put all this together and most Fed members would agree that, the Fed is still, even after the cut, restrictive by at least 25 basis points, right? But what influences this? Well, the R star estimate and inflation. And while inflation's 2.8%, even Jerome Powell himself said it's really closer to 2% when you remove the temporary impact of tariffs. And here's just some of the impacts. Look, core PCE is 2.8, but shelter's overstating it by 0.3. The tariffs overstating it by at least 0.3, maybe probably 0.4. Portfolio management, which is a really stupid metric where, if you have an investment advisor charging you, let's say 1% on your portfolio and your assets go up and now you're paying them more, they count that as inflation. The rate they're charging you hasn't gone up. In fact, you're happy to pay them more because that means that your assets have grown in value, but they count that as inflation. But you add this up, and this is where I think real core PCE is a lot closer to 2%, maybe even under it. So if you were to use this in this calculation, well, then it shows you that you actually could cut 1.5% almost, or at least 1.25% before getting to levels of neutral. And that's the reason why you see people like Stephen Mirren, who thinks that you can actually cut more than this because his number of R star is actually even a little bit lower. So that is kind of why, the main reason why there's such differing views out there. Some are more worried about inflation, some more worried about the labor market, but really the level of restriction is something that's not concrete. And there's a lot of opinions on that level based on the metrics that I just showed you. But here's something I want to show you on Fed rate cuts. So, this points to 2024, and I think it underscores what I was trying to explain before. So if you remember back to last year, September 18th, which is right here, this is the Fed funds rate. This was the 50 basis point cut that occurred. Now, a lot of people, I think, incorrectly point there and say, well, listen, rate cuts, they don't help at all because mortgage rates ended up going up after the Fed cut 50 basis points. But here's the thing. Remember, you can't just have a myopic view. What happened in the few weeks before the 50 basis point rate cut, once the markets learned that the Fed was indeed going to cut 50 basis points? They moved down by 5/8 to 0.75% on 30-year fixed rate mortgages. Then the Fed cut right here, and you'll notice 30-year fixed rates, they actually remained stable for 2 weeks. Then on October 4th, they started to move higher. Now, remember what I said, you have to see what happens before. Well, clearly the long end even here priced in rate cuts, but then was there coincident economic data that caused rates to go higher? Well, we got a 254,000 job creation report for the month of September that was released October 4th. That really started rates moving higher. You add to that November 227, December 256. Now, we were saying all along, and finally the QCEW confirmed this, and now even Powell saying there's a crazy overstatement, that 52% of these jobs from this year never occurred and were BS. But you can have coincident economic reports that do this. I want you to pay attention to this long-term chart. Now, the blue line is the Fed funds rate. The green line is 30-year mortgage rates. Now, by no means is this in exact lockstep, but I think you'd have to say that these certainly do trend pretty closely together over time. So do I think that the Fed cutting rates automatically means mortgage rates are coming down? Absolutely not. But do I think that, it certainly does typically have an influence on pressuring rates lower, especially over time? I do, so long as it's not viewed as inflationary, and so long as you don't have some crazy economic reports that are coming out that are sending rates higher. And if we just look to this year, the first cut September 17th, back August 22nd, we learned at Jackson Hole that we were going to cut. So if you look from when we learned and the market learned to when they cut, 10-year yield moved down by 0.25%. Mortgage rates moved down by 3/8. Then they cut on September 17th because the labor market was weak. What happened the next day? We got a really low initial jobless claims report. Then we got a really strong GDP and durable goods report. And it was somewhat contrary, not exactly because we're talking about claims versus jobs created, but it was somewhat contrary to the reason why the Fed cut, and that caused rates to start to move higher again. So, it's a little bit of a Rubik's Cube, and you can't just look directly after the Fed cuts and say, see, it doesn't help. I do think it does have influences for sure.
I hear a lot of people explain like that and go into kind of depth, so I appreciate you doing that. The other thing is that I take away for people that are saying, hey, rates are going to come down or I'm going to wait. You may be waiting a little bit. And the other thing I took away is that markets price in everything. Like, obviously, you're smarter than many people that are in the room, right? But you get it. But so are the people that are pricing this out. And so when I take a look at this, I go, hey, listen, if you're anticipating a rate cut to lower the mortgage rate, that's already happened in the pricing. So don't sit back and go, I'm going to wait again another week. It may come down, because consumers do that.
And no, right? So, like, for instance, with this meeting, it was kind of back and forth with like pricing in the rate cut, right? Like after Powell made his comments, there was like a 33% chance of a cut, and then it started to edge higher. But then the week of the meeting, it was up to like 90%, but it was expected it was going to be hawkish. But the rate cut itself usually does kind of get priced in, especially as you get closer. But then the comments can change everything too, right? So just like we saw October 29th, you saw rates starting to come down going into that rate cut. And then all of a sudden Powell delivered the hawkish cut and rates went up. So, there's a couple different components to it, but I will say this, I know we talked about this before, Quentin, before hopping on. I know everybody's probably curious as to where we see rates going, right? And I want to just show you, kind of walk you through how I think about this. So I do think inflation is going to come down, and I do think the labor market's going to continue to show weakness. Both of those things should be favorable for mortgage rates. Now, here's the other thing, is Scott Bessent, the Treasury Secretary, he wants to see the 10-year around 390. He actually spoke with my father, Barry, and he gave him his target, which not far from our target, which is around 380 on the 10-year. So he said that there's a few things he can do to do this. Issue more short-term debt, which we talked about at the beginning of the call. But also something called bank deregulation would be big, and I think it will be passed next year. A bank, how do they make money? We deposit our money. They pay us very little on our deposits. And then they lend out that money, or most of that money, at a higher rate, and they make the spread. But right now, as it stands, if they were to take depositor money and go ahead and invest it into treasuries and make a return there, it would limit how much that they could lend out, because there's certain capital ratios they have to have. Bank deregulation, whether you agree with it or not, would say, listen, treasuries are risk-free assets backed by the full faith and credit of the government, so they shouldn't So it would really open the door for a lot of reserves out there to be invested by the biggest banks into treasuries, especially on the short end, and absorb a lot of the supply. The Fed also ended their runoff. So any assets that they're getting that are maturing from mortgage-backed securities, payoffs, whatnot, principal payments, they go ahead and reinvest those now back into treasury bills. Any treasuries running off the balance sheet, they're reinvesting back into treasuries. So their balance sheet is staying net neutral, but anything rolling off the balance sheet that was rolling off, they're now reinvesting. You have the Fed outright buying $40 billion a month in bills, right? So if you could issue more short-term debt, boy, you can certainly provide less on the long end, and that would help rates come down because there's less long-term debt there to absorb. Almost think of it as like, if you had a housing market that all of a sudden you were flooding with supply, well, there's going to be demand at some equilibrium price, but when you have so much supply, the price or the demand level, it's going to be at a lower price. And in what we're talking about here with this debt, a lower price means a higher yield, right? So, and then one more thing is stable coins, which is cryptocurrency. And you might be like, Dan, how the heck can cryptocurrency help us here? But stable coins, I think, are really the future for transactions. They bridge the gap between the dollar and traditional finance and cryptocurrencies and the blockchain. And a stable coin is like a crypto version of the dollar. It's pegged to the dollar. And the way they peg it to the dollar is 80 to 90% of what the stable coins own is short-term treasuries. So that market's expected to explode, where I think by next year, stable coins are going to own a few $1 trillion worth of short-term treasuries. So you put all that together, boy, it makes a lot of sense to issue shorter-term debt. Those things can help. But I also think we're going to continue to see mortgage spreads come down. Now, one of our forecasts we made at the beginning of the year was like a low in rates of, I think around 6 1/8. We said mortgage spreads would come down from 2.80 to 2.25. And we said we see appreciation around 3.5% or 3%. Yeah, I think we came very, very close on all those targets. But the mortgage spread one, boy, right now, mortgage spreads, which is the difference between a 30-year fixed rate mortgage and the 10-year treasury, they're right around 212. So it's actually a little beneath our target. And we want to see this come down, team, because this is the difference between the 10-year and mortgage rates. And throughout history, normally mortgage rates are 1.6 to 2% above the 10-year. But then you have periods of time where this widens, right? Where you had COVID, you had all the QE and the Fed cutting rates to zero. You had the Fed hiking and quantitative tightening. Remember back here, this was like October 2023, where you had the 10-year at 5%, mortgage rates above 8%. It was like a 3.1 spread. I mean, that was ugly. Part of the reason why you see that happen, something mortgages have that the 10-year doesn't, is servicing values, right? Where there's a lot of things that go into valuing a mortgage, which then in turn impacts the rate, right? And if rates are really high, there's what? There's a very big repayment risk. As soon as rates fall, you're going to refi out of that sucker. So there's very little servicing value in that mortgage. It's not expected to stay on the books very long. And that's one of the components that can cause the spread to widen. But then as rates come down, more servicing value continues to enter into the equation. And you can see mortgage rates come down at a bit of a faster clip than the 10-year, hence the spread narrowing. Well, right now we're around 212, 215, let's call it. I think we can continue to see that spread narrow next year. So I think we could see the 10-year hit our target of 380 next year. We're going to have, I think, some better inflation figures. I think the labor market's going to continue to be weak. I think we're going to get a more dovish Fed, obviously. And I think the 10-year can move down to 380. And if the spread narrows down to like 180, which I think is extremely possible, I think that there's a chance we could get certainly under 6% and maybe even touch like 5 3/4 or so. Now, do I expect that to be like a long, like a long time period that we're going to be there? No. So it means that you got to make sure you're putting in the work now, right? Where you need to make sure you have your ducks in a row. You're setting up strike rates with customers. You're keeping in front of your past database of customers, right? And making sure that when rates do come down, you've already got them to kind of pre-commit. And also, as the Fed cuts, remember, adjustable rate mortgages, SOFR comes down and such. There's a lot of companies I talk to that have attractive ARM products right now, but you're going to see ARMs likely continue to get more attractive as the Fed cuts and the yield curve steepens. And I think that they're a great option. There was people out there like Bill Pulte saying you should do a 50-year mortgage, which I don't think is a great idea. I do like the idea that they're trying to get creative, right? But I don't think that's a very good one. However, if you educate your customers on ARMs, you could probably get the same savings that you would see in rate and such, but in much better situation for them. And then when you use a tool like MBS Highway and you quantify for them that, listen, even in a worst case scenario, it's mathematically better for 9 years, not just the 7 years of the 7-year arm, let's say. Or if you use a historical scenario, it may never be better than the 30-year may never be better. You can really get the customer comfortable with it.
No, I think that's great. And I think that 2.12 spread is highly welcomed. I mean, best we've seen in what, since 2022?
Yeah, it's the best spread we've seen in a while, but we're still well above historical norms. And I think we can definitely get under 2% as far as the spread next year. And we think it's going to get down towards 180.
This time last year, I think we were at 2.72. So to see it drop that much in a year is great. 280, yeah. So, I mean, to get in that 565, 575 range, to your point, how long, right? I think the spreads are getting better because we've been more consistent in the rates. And to your point, that servicing has become more valuable. The investor uncertainty is kind of going away. So the question is, at this 575, is it one of the things like where you go up and you touch the rim and you hang on and you come down, or is it more of a longer journey? And now time will tell.
Yeah, I don't think anybody knows for sure. I certainly don't. But I do think it's a level that we can certainly get to as far as like a low for the year, right? But I think we could spend some time under 6%, right? And I think as a low target, I feel pretty comfortable saying like 5 3/4. But I don't anticipate that you're going to have like a long period of time there, which is why I think that, you need to be prepared for that opportunity when it presents itself.
Yeah. No, great stuff. Well, Dan, thanks for being on the show. I know you've got some plans here. You got to hop off, but man, as always, it's wonderful having you on the show. Guys, all these charts, all the breakdown, everything he did will be on our YouTube channel at What's Your One More. Dan made a mention there of something I don't want you not to think about. MBS Highway. If you're not using this product, you are missing out. It's an industry leader. The strike rate, home report, list reports. It's the trio package. You cannot not work in this business and not have a part of that. So Dan, thanks as always being on the show, brother, man. It's great getting your insight, your resources. I appreciate you being on here, and you heard it here first. 575, we're going to get there. How long we stay, who knows? But till then, Dan, thanks for being on the show, brother.
Thanks for having me.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.